This is the CRE Weekly Digest by LightBox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Martha Kocher with Manus Clancy and Diane Crocker. This week, we're talking with Spencer Levy, Global Client Strategist and Senior Economic Advisor for CBRE and host of the Weekly Take podcast, which is one of my favorites. Spencer is frequently quoted in major publications. You probably see him on TV, CNBC, CNN, Bloomberg, PBS, Fox Business. So you're highly sought after, Spencer.
It's nice to have friends. It's also nice to be recording this during Thanksgiving week to have my family home too.
That's great. Yeah, you've got a full house this week, I hear.
I do. Everybody's home from college, and what was my favorite week of the year only got better.
Well, that's great. Well, hopefully we can have some fun with you here this week, learn a little bit. I'm going to start out by asking you to take us through how we've gotten to where we are today. I know you recently did a presentation and had the concept of walking through the yellow brick road.
Well, I think there's two ways to look at the world, right? The glass half full, glass half empty. Things are good, things are not good. So I like to compare and contrast the period pre-COVID and the period post-COVID. Pre-COVID was the yellow brick road because pre-COVID, we had low interest rates, we had cap rates going down, we had a stable economy. Geopolitics wasn't as rough as it is right now in terms of a lot of global wars. So it was a much better place then than it was post-COVID, certainly after 2022 when inflation started biting us. The last 2 years are whatever the opposite of the yellow brick road is, because inflation really changed the entire industry, because only one other industry that's more interest rate sensitive than the real estate industry, which is tech. And a lot of people don't understand why, but the reason being is that tech companies, the big ones, are all growth companies, and they're valuing their incomes on long-term basis. So even a modest change in interest rates really changes the value of those enterprises. But nevertheless, interest rates matter to commercial real estate a lot. And it really caused our industry to, shut down's the wrong word, but slow down tremendously in terms of sales, in terms of refinancings. And the good news is fundamentals until recently in all major asset classes, with the exception of Class B office, were very strong. Multifamily were strong. Industrial, obviously, you've got these sub-asset classes, data centers, single-family rental we can go into. But recently, we've seen some cracks in fundamentals too. We've seen industrial fundamentals get weaker. We've seen multifamily fundamentals get weaker. But believe it or not, and this is going to be talking out of both sides of my mouth, the one area where we're seeing actually tremendous strength at the moment is going to shock you, which is office, but for the best office in the best submarkets. But nevertheless, how did we get here to where we are today? We came here through the combination of inflation leading to high interest rates and a secular shift in office leading to these Class B office buildings, story still being written. And then this extended period of time of uncertainty causing fall off in demand in industrial and oversupply in multifamily leading to softening demand there.
Thanks again for being here in this week of gratitude. I think some of our listeners from LightBox might remember that you were our market keynote at Prism 2019 in Nashville.
Diane and I are longtime friends, and not only are we longtime friends, and saw Diane at a presentation the other day, we are even better friends on LinkedIn because Diane and I correspond back and forth on LinkedIn. So if you're not on LinkedIn, well, go on LinkedIn. It enhances your relationships in the industry.
100%. Thank you for that. And I would say for any young professionals out there, if you're not following Spencer on LinkedIn, I strongly encourage you to, because he is a lesson in how to use social media to connect with folks and share information. So you just hit on interest rates and how sensitive our industry is to rates. You know, what's your take on them? We just had 2 rate cuts finally, but should we be looking for rates to stay higher a little bit longer? It seems like there are a lot of conflicting barometers out there.
You should know that the general consensus, including ours, including Wall Street and others, is that interest rates are going to stay higher than any of us had expected for longer. And our house view is that both the long and the short end of the curve are going to stay higher than we had thought even before the election. And now the election it's not good or bad, it just is. It's a result that because of a Republican sweep is likely to be more inflationary. It's likely to be more inflationary because we're likely to have lower taxes, we're likely to have higher tariffs, and we're likely to have restrictions on labor. And those 3 things together combined are likely to be more inflationary. Now, on the flip side, we just had an announcement of President Trump's new Treasury Secretary, and he is a deficit hawk. And that's a very good thing for the economy. If we can get the deficit down, that reduces government spending, which is a significant driver of inflation as well. And it will help us over the long term. The other thing that could help us over the long term is a lower price of oil. And that's yet another of the potential policies of the new Trump administration. So while we have these headline things of tariffs, taxes, and labor that are inflationary, we have the deficit reduction and oil price reduction that go in the other direction. But the long story short is we think the long end of the curve is going to hover around 4% for an indefinite period of time. I know it's 4.3 today. And the short end of the curve, while we do expect it to continue to go down, we had our terminal rate there at around 2.5% in 2026. The terminal rate might be closer to 3%.
In my mind, commercial real estate's at such an interesting place post-COVID because we came out of COVID, as you said, into the land of higher interest rates. But at the same time, there were these fundamental movements on the asset class size that were really changing the way that we live, the way we work, demand for real estate. And one of the reasons I think it makes you so interesting to listen to is your bullishness and your broad worldview. And I wonder, what are some of the kind of really broad trends that you see shaping commercial real estate opportunities?
Sure. Well, I talk in terms of two basic megatrends that are influenced by outside forces. So the first megatrend is the reshoring of manufacturing, which is influenced by geopolitics. It's influenced by our, unfortunately, deteriorating relationship with some foreign powers and causing us to bring some manufacturing back. And the second one I talk about is the movement of the nexus of economic activity from CBDs, central business districts, to live, work, play neighborhoods. So those are the two basic megatrends. The first one is the reshoring. And a lot of people in real estate, in commercial real estate, say, well, what does that mean for me? Because I don't really invest in manufacturing. That's what most of our real estate clients will say. And my answer to them is like, well, you should know that around these manufacturing facilities, you see all other forms of commercial real estate, including but not limited to data centers, industrial, you see multifamily. And the case study I always use is, even though my son is a proud junior at the University of Michigan, is in New Albany, Ohio, right outside Columbus. And the reason I use it is because that's where the new Intel chip plant is, and these data centers and these multifamily sites. And I tell our clients, you have to look there as a place to invest in other types of real estate because you can get superior yield. And I'm going to use that word very specifically, current yield, because over the next 5 years, if you believe where the interest rate forecast is going, which is higher for longer, over the next 5 years, you're going to get a disproportionate amount of your investment return in current return rather than in cap rate compression, which completely opens the door to these secondary locations. And I would say one other thing, many of the large institutional clients I talk to don't even think Columbus is secondary anymore because of all this economic activity. I know it doesn't ring true to my ears either, but some people are beginning to put it in the same category as Austin, Nashville, Salt Lake City, Raleigh. Folks, I can name every market in the country, but it only rings true to me when I see the capital flows, when I see the money going in from traditional institutional sources like we've seen in Salt Lake City, like we've seen in Orlando, like we've seen in Austin, like we've seen in Tampa now. Now we're beginning to see it in Columbus. So that's megatrend number one. Megatrend number two is the shift of the economic nexus of activity within cities from CBDs to live, work, play neighborhoods. Just some context. Core funds, which are one of the biggest investors in real estate, had about 40% of their investments in real estate in 2005 in office, all right, about 40%. By 2015, that was 25%. Now it's going to be dropping to about 12% because of all these other asset classes, okay? So that's point A. Point A is they're moving from CBDs to someplace else, and that someplace else they're moving is both by asset type, so they're doing a higher percentage of multifamily, industrial, retail, and some of these sub-asset types, but they're also moving physically to where people want to live, work, and play. So a comment that I made earlier in this discussion about office strength, I want to be very clear. It is a very narrow discussion because it is in these neighborhoods. So I had a client on our podcast, The Weekly Take, Glenn Gilmore, CEO of Bricks and Timber, and he owns nothing but office buildings in San Francisco. And you're like, oh no, he must be doing terrible. Nope. He's 100% leased in his buildings in Jackson Square because he's in one of those neighborhoods. And where else is he buying now? Wynwood in Miami, another one of those neighborhoods. And if I can shamelessly plug one of CBRE's report, the one report I would advise our listeners to read is the Tech 30 report, because the Tech 30 report lists the 30, not the market. People ask me all the time, what market do you like? I'm like, none. But I like a lot of submarkets, because the submarkets is how you need to break down these cities, even cities that are disfavored. Chicago, look at the Fulton market. Take a look at Philadelphia, University City. There are places even within disfavored headline markets that are terrific commercial real estate opportunities.
So that leads me to a question on that. Certainly, the evolution from the CBD to these new neighborhoods has been a net positive for those new neighborhoods. And people have been making a lot of money that have kind of front-run this migration, if you will. The question is, for the CBDs that are left behind, awful lot of talk about conversion to multifamily and so forth. How do you see that playing out in most of the U.S.? Is that going to be a success for intrepid developers?
When I started off in this business many, many years ago, I worked for a developer, and we bought half of Wall Street for less than $100. And when we were buying these things in the mid-90s, we were hoping that we would convert some of them to condos, and maybe we get $300 a foot on the sellout. Those condos are now selling for $4,000 a foot. Okay, so it obviously has worked out over time, but that was 30 years ago. It takes a long, long time to do it. So will it be a success? I believe it will, but it depends on your definition of how long does it take. Because I think it's going to take decades. I don't think it's going to be we got a new tax incentives or permitting got faster, both of which we need, but it's not going to happen quickly, because the process of conversion, before you even swing a hammer to start the interior demolition, you got to raise capital, you got to get permitting, you got to do all kinds of stuff. It is hard. It is a slog. So yes, I'm optimistic over a longer period of time, but I'm not optimistic that's going to happen in the next 5 years. I think it's going to start, but I think you're going to see the results of this over the next 10, 20 years.
As I continue with my stream of consciousness, I have one more for you based on your last answer prior to the one about conversions, and that is, you mentioned data centers, you mentioned industrial demand, onshoring, and so forth. We've seen some staggering prices for land purchases in Virginia, in Minneapolis, around Minneapolis, for data centers, hundreds and hundreds of acres. Is this a net negative for housing prices, for multifamily development? Is this going to be a problem? Whereas the Toll Brothers and the Lennars and the multifamily developers have gotten land at a certain price for the last 20 years. Now these buyers are coming in, paying premium prices for huge swaths. Is that going to be inflationary to housing, an area of the economy that people are already concerned about?
In certain instances, land can be used for either industrial or multifamily, right? In most instances, you can't. In most places, it's not zoned for multifamily. Now, you're talking to a guy here who wants to change the zoning of a lot of these things so you can put multifamily. The place I really want to change the zoning is in a lot of these older corporate campuses that are located pretty close to suburban areas, and rezone those for multifamily, at worst single family. Problem is, it's very difficult to build additional housing units in suburban areas. So your question about whether industrial land crowns out multifamily, I think only at the margins. I think really the inflationary pressure on housing costs really is primarily related to labor costs, interest rates, and then the impossibility of building in places that won't let you build. That is really the number one problem, is simply local municipalities that are keeping additional housing out.
One point I remember you saying in Hartford, and you were quoting somebody, was the solution to the housing shortage is simply to build more housing. But then, of course, the hope is that it's affordable so that our kids don't move back home after college, right?
Well, look, I think there's a lot of, I'm an affordable housing advocate. I'm proud of that. And there are some things out there that can make housing more affordable in the short term, with restrictions on how much your rents can go up, that don't work over the long term. What works over the long term is more supply. And it is a real nettlesome problem, because what do you do in the short term? And that's where we're big advocates of Capital A affordable, LIHTC credits, big supporters of Section 8 housing credits, and any credit you can give to a home, or rather a renter. Amen. Anything. But restricting the capital markets is not one of the things I would advocate, because it restricts new supply. Simple as that.
And I think one of the exciting things about the market in general that I alluded to before was just there's so many new opportunities for adaptive reuse that come to the surface as we start thinking about what are we going to do with the obsolete malls or office buildings that have outlived their usefulness. And that's, I think, in the next chapter of real estate is going to present some exciting opportunities. But let me ask you this because it's a question I get a lot, and we've all been through various commercial real estate cycles in our career. And it's, investors always have this FOMO, this fear of missing out, this fear of waiting too long before they put capital into play. And I think the narrative for a lot of this year was rates are too high. And when rates start to come down, people are going to move money back into play. And now you're telling us that rates are likely to stay higher for longer, which I don't disagree with. But I'm wondering, a client comes to you, Spencer, and says, look, we're ready to deploy capital. When's the right time to move in? So what are you telling them?
The first question I ask every client isn't the cost of your capital, it's the time horizon, which goes a little bit back to what I said before about these conversions. Like if you got a long enough time horizon, it's a great opportunity. But if it's short term, much more difficult than you think. But because I think if you have a longer time horizon, two things are brought to bear. Number one, your cost of capital is lower by definition because you can't get a 20% cumulative and compounding return over 20 years unless I suppose you can. It's hard, but you lower the cost of capital, which allows you to go longer on not just the time horizon of the whole, but actually being able to put a shovel in the ground today because many institutional investors can't get to their yield to cost metrics today. And typically a developer in multifamily for years was trying to beg, borrowing, and stealing for a 6, right? And now it's a little higher than that because the cost of capital is higher than that. It's made it even harder. But if you have a long-term time horizon, you can do more. So assuming you have a long time horizon, I'm advocating that my clients today build today, including multifamily, including industrial, where there's oversupply in both. Say, how could you say that there's oversupply? Because by the time you're done with that job, it's going to be 3-4 years from now. And you're going to be the only new supply in the market. And you're going to be the best game in town, and interest rates will be lower than 2, even if they're not as low as you think. So that's number one thing I'm recommending. The second thing I'm recommending is follow the megatrend, the live, work, play megatrend, but also this manufacturing one. I will tell you that is a steep road to climb because most of them say we have liquidity risk on the back end. Well, if you have a long time horizon, you don't really have to worry about that much, number one. And number two, one of the biggest inefficiencies in our business, what you use for your advantage, is that the federal agencies, Fannie Mae, Freddie Mac, give basically the same pricing for you if you're in a secondary market as if you're in a primary. Why shouldn't you take advantage of that?
So Spencer, you speak to everybody via your podcast and your speaking engagements, your research and so forth, incredibly well followed on LinkedIn. You've given us your perspective, which is glass half full. You said you're generally a positive guy on real estate and so forth. In terms of the people that you're speaking with every week, are they seeing the glass as half full or do they need convincing?
Very good question. And because there's an interesting split right now, which is consistent with the answer I just gave, which is for people that are high net worth and have long-term time horizons, very bullish right now, not only on new development, secondary markets, but buying some of these distressed properties at a song. It's the institutional investors, particularly the core funds, that are much more skittish. And the reason is that they're locked up a little bit. Many of them still have big redemption queues, so they can't invest new. Many of them have legacy assets, particularly office buildings that are saddling down the portfolio. So the bottom line is that you have a split today where the high net worth individuals, this reminds me quite a bit of the GFC where I saw a lot of the same activity, are much more bullish at the moment than institutions, though the institutions do want to get back in because they're seeing the bid-ask spread narrow. Office is still an animal unto itself that it's still disproportionately high net worth going in there solely. But for the other asset types, the institutions are already backed.
What does your forecast look like for the short term? And what can we say we won't hold you to your predictions for 2025?
So we believe that 2025 is going to be a better year than 2024. And that's not hard to say because 2024 and 2023 were kind of tough years in the capital markets, even though we saw an improvement with respect to debt and structured finance. But that slowed down a bit when the 10-year jumped by about 60 bips from August through October. But we expect interest rates to continue to come down, spreads to come in because there's greater business optimism today than there was before. So we think it's going to be a better year than 2024, but we don't think it's going to be a record year. And the reason why we don't think it's going to be a record year is because we still have an overhang of excess supply in multifamily and in industrial. And interest rates aren't going to come down as quickly as we thought. But is it going to be a better year? Yes, because there's pent-up demand, because business optimism has improved, and because we believe that the interest rate environment, because it's getting better, will spur more activity. So, and I'll give you one other reason why I think it's going to be better. The two major categories of investors that are kind of sitting on the sidelines right now, one we discussed, which is a lot of the institutions. The other one is foreign money. And foreign money typically represents about 15% of all investors into the U.S. This year, it's about 3%. And I say, well, why is it so low? It's so low because if you're a foreign investor and you can buy a AAA bond at 7%, why would you buy a multifamily deal at 6%? And so as you see the relative value of these bonds drop, the alternative looks better. And I say this just matter of fact, I'm not judging, but if the world stays rough out there, which it is pretty rough, the U.S. is always considered a safer haven. So I think the dropping of interest rates, more dangerous world that we sit in today, will favor commercial real estate values in the United States.
So I'm mostly in the glass half full camp, and I agree with everything that you just said. But for listeners who aren't, I wonder if you could comment on what's your worst case scenario? What do you see as the greatest risk that's facing commercial real estate now? And hopefully, Manus, this doesn't make your blood pressure go up.
Look, I'm not going to go geopolitical here. I'm just going to go bottom line here. We got inflation wrong. If we got inflation wrong and we see a double dip of kind of like what we saw in the 1970s where they had to raise interest rates again, that to me is the worst case scenario. And look, core inflation isn't licked yet. It actually ticked up a little bit. And the biggest culprit there is housing prices. And it's sort of a vicious cycle because part of the reason why housing prices are so high is because interest rates are so high. And so which one moves first? If inflation stays sticky, and then I guess the worst case scenario is that it spikes up again, that is the worst case scenario. That would cause a significant pullback in our industry because COVID was worse. Okay, so I'm taking that kind of scenario off the table.
However, your Weekly Take podcast was an offshoot of COVID, so it wasn't all bad, right?
What else were we going to do, Diane? You know, in March of 2020, we were like, what are we going to do? You're in my home office right now with extra screens, microphones, lights, because I did television interviews from this chair. And so what are you supposed to do? Well, you know what we decided to do? Communicate better with our clients. And that communicating better with our clients was in the way in which they wanted to be communicated with, which is orally, you know, the spoken word rather than the written white paper word. And the other thing I got bigger on was social media. People want little snippets. They don't want to focus on, you know, long written stuff, even though I read everything and I read the long written stuff and I write some of it. The point is that it helped us communicate with our clients better. It's been a silver lining to what was a catastrophic event.
What's exciting to you about retail? What are some of the broad trends that you're seeing?
The most exciting trend is going to be completely self-serving is I get things wrong all the time, as we talked about in the pre-show. And I was wrong on my inflation outlook. And we were a little bit too optimistic about interest rates coming down sooner. So listen, mea culpa, I admit it when I'm wrong. But doggone it, I was right on retail. And I've been saying it for 5+ years that open air retail is the most undervalued asset class in real estate. And I came in second this year to data centers. Okay, so I didn't get the number 1 slot, but I got number 2. But it was obvious. And it was obvious for 2 reasons. It was obvious because, number 1, there's no new supply. And the new supply that comes on is above replacement cost for most. So it's very hard to build new supply. And consumer is still spending. The biggest reason why I knew it was undervalued, it goes right back to a theme that if you really listen to my comments here in the podcast, you'll see is one of my most important themes. Follow the money and follow where the money isn't going. Institutions pulled out of retail in a similar vein that they're pulling out of office today, which creates the opportunity. Because institutions push value. Okay, what's happening today? Because institutions are cycling out of office, they need to find something to fill that gap. Data centers aren't big enough. Senior housing, student housing isn't big enough. Retail is bigger, and it's a big piece of that puzzle. And as institutions jump back into the sector, cap rates will compress because that is how the flow of money works. So I just given you the big picture on it. Now, just jumping into the consumer sentiment is very good right now. And I think that we're going to see a very strong holiday season, notwithstanding the fact that a lot of the post-COVID stimulus has washed out of the system, and it's hurting certain segments of real estate. There's certain segments of hotels that have seen softening because the consumer isn't traveling as much as they were. But nevertheless, we think that there's enough positive consumer sentiment to give us a strong holiday season, even if some of the liquidity from COVID is now gone.
I hope you're right. I feel like they have to rename Black Friday to Black November because they started the deals early this year, it seems.
I got my cool new holiday gift already. Got it on Monday. I got a brisket knife because that's in the Levy household. While we have turkey, I have 28 pounds of brisket with my name on it downstairs that I got to cook over the next 48 hours. And it looked like a samurai sword, to be perfectly honest with you. But that's my gift, and I was real happy.
And what is the brisket? Is it a smoker? How do you cook the brisket?
Well, I remember the traditional brisket that I would have in a New York metro area was kind of a pot roast, right? It was like soft and oniony and brown, very good, but like a pot roast. My wife, her mom's family is from Texas, and a Texas brisket is a completely different thing. It is black on the outside, has a red ring, and that's what I do. So I have 2 smokers in my backyard, and we fire these puppies up, and it takes 20 hours to do each one of them. So it's going to be 40 hours of cooking between now and Thursday.
I'm equally devoted to the Texas brisket and the pot roast. I like them both.
There's a time and a place for both. With my pot roast style brisket, which I make, put a ton of horseradish on it. Fantastic.
The brown gravy?
Texas brisket, I eat it with coleslaw, jalapenos. Fantastic.
We got to have Spencer in person one of these days and have him bring some of this brisket in. We got to, next time we have him on the pod, we got to do it in person.
Sounds much better than turkey, too.
Well, you can make a good turkey. So believe it or not, now that we're on the cooking portion of today's podcast, the cooking a turkey or a chicken on the smoker, you do it right, unbelievably good, really tender. I sometimes cook a turkey breast alone on the smoker. I turn it into turkey pastrami. Amazing.
I guarantee if you ever retire from commercial real estate, you could do a pretty successful cooking podcast just based on the folks that follow you now.
I want to see Spencer take on Bobby Flay. How does that sound?
Great.
I think he's got a little bit more experience than me, but nevertheless.
We wanted to highlight your role in the Real Estate Roundtable. Just what are you thinking and talking about?
As we've talked about, Diane, I'm the chairman of the Real Estate Roundtable's research committee. I've been in that role for over 3 years. But I've been doing a lot of work with the Roundtable for well over a decade. And the Roundtable, for people who don't know it, is a subsidiary, not wholly owned, but they're separate entities. But there's the Business Roundtable, and then there's the Real Estate Roundtable, of which many people are members of the Business Roundtable, which essentially lobby the federal government for policies that'll either be business or real estate friendly. And some of the things that we're working on now include the following. And in no particular order, but first, we're trying to maintain liquidity in banks. And so there was this thing called Basel III that would have reduced liquidity to real estate. If you were following the news a couple of months ago, that was put on the side, which was great for our industry because the last thing we need is less bank liquidity. You should know that SFR BTR, even though it's a top sub-asset class for our institutional investors, is not a favored asset class in Washington or in state legislature. So we're trying to push back against that. A new topic, which is incredibly important, is insurance, property and casualty insurance. And anybody on this call who has a multifamily deal in Florida knows what I'm talking about. The prices have gone to the moon. And we're trying to figure out a way to mitigate those costs, maybe by federalizing some of it, much as we federalized terrorism risk insurance. We federalized flood insurance. Maybe there's a play there as well. And then there are several other issues having to do with how you tax carried interest and issues related to the flow of foreign money. One of the first issues I ever worked on for the Roundtable a decade ago was this law called FIRPTA, Foreign Investment in the U.S., which essentially put a 10% exit tax on foreign investment into the United States. And we pushed back hard and we won. And we got exemptions for pension funds. But now you're seeing many state legislatures pushing back and say, well, we want to put more restrictions on foreign money for national security reasons. I certainly understand and respect the national security reasons as much as anybody, but we need to have this as narrowly tailored as possible because we cannot stop foreign capital coming to the United States. It is incredibly important for the overall economy, but especially commercial real estate.
All right. So I have a very important question, Spencer. In looking at your weekly take subject themes, and by the way, we're very interested in themes because we do this every week and think about what's this week's theme. I noticed a lot of musical allusions, a lot of rock music allusions. All right, who's the music fan in your group?
I'm sitting here in my home office and I'm now pulling out my vinyl record collection. Sitting here, these are the ones that are closest to my desk. The other ones are over there. And sitting here in my vinyl record collection, in no particular order that I just pulled it, are the Black Keys. We've got the Eagles. We've got Adele. We've got Pink Floyd. We've got Prince 1999. It's me. Okay. We have lots of music fans on that show, but I take second place to no one on that particular category. In fact, I get a lot of grief from my good friends in Corp Comms who try to cut as many of my music references as possible, which is why I put so many in the show so that they are overwhelmed and maybe I get 10% of the references. But I have sitting in the corner of my office right here a vinyl record player, which I love. Even though I've got my little Amazon device here and I can just call up a song anytime, vinyl has reintroduced my love for music. And the reason is that music isn't just an auditory experience. You pick up the jacket and you read it and you see the artwork and you get closer to the artist. And even if there's a little crackle on that thing, that's great. Even if I got to pick up the needle once in a while and put it down, that's great. It adds to the experience. So vinyl records outsold CDs 5 years ago, and now it's completely blew it into the dust. Everybody out there, you want a new experience for the same stuff, go vinyl.
I think the time has come for Spencer to have his own live audience show with some Brisket, some live music, some recorded music, some vinyl music. I think, your own venue is overdue.
Vinyl and Brisket, or we got to work on that title, but something like that.
Love it. Thank you, Spencer, for joining us today. And thanks to our producer, Josh Bruning. Please join us every week as our Lightbox team shares CRE news and data in context. You can listen on any of your podcast channels and send your comments or questions to podcasts@lightboxre.com. Thank you for listening and enjoy the week.